Hi there, traders. This is Brad Goodwin with the Daily Market Insight for Thursday, the 4th of November. Right now, the Fed has come and gone. As expected, they did come out and give us the dates or the starting points for their tapering, right? Let me just come over and give you a little bit of a look at this. So this was pretty much factored in, right? If they didn't do it, the dollar gets sold off. If they do, and I was saying this yesterday, that it's not going to do much for the dollar. And if anything, the comments here from Jerome Powell, a little bit dovish in one aspect. You know, he believes that high inflation would prove transitory, right? So what they want to see is this is the plan. We're starting to taper, but they're trying to cool the market's expectations of rate hikes, right? They don't want the market freaking out thinking, okay, we've got, they're starting to taper, we're going to have higher interest rates. I think what he's trying to do is just calm everyone down and say, well, we're not moving on rates yet. We're going to see how things go. And in actual fact, we think inflation is going to drop, right? So that's where we are. That positions us for the next leg of the dollar move. So Friday's non-farm payrolls will be very important to that. Then obviously following up from that, any inflation data, the CPI, the PCE, et cetera, will be important to when are they going to raise rates, okay? So, but the dollar has, you know, there's been a bit of a reshuffling, right? If I just come back to the main data page, now the yields are a little bit higher, okay? There's been a bit of repositioning here. The long dated stuff, the prices are falling, which means the yield is going up. So a little bit of a rebalance here, a readjustment as we go through the Asian session following the FOMC. Equity markets had a pretty good day. I'd say a lot of that would be on the back of also them saying, you know, we're not going to be raising interest rates anytime soon. And in fact, you know, inflation will be transitory. So that's where we are at the moment with the markets. If anything, with that move in the equity markets, right, let me just clear that. You've got a clear risk on day, right? So the dollar has drifted lower. Once again, dollar yen, the odd one out. But euro, sterling, Aussie, Kiwi bouncing off their post FOMC lows, right? Just on the fact that, you know what, we know the picture, we know the plan for the dollar. The Fed has given us a little bit of a negative spiel on what they think is going to happen. We need to let it play out. So there's just a bit of a repositioning. So that's why I think euro, sterling, Aussie, Kiwi are just coming back a bit. Let's just have a look at the charts. Most of them are in the middle of nowhere. Notice it's quite weird, actually. Euro, very muted, right? Reactions compared to, you know, these, I mean, I know Aussie and Kiwi had to have a bit of a catch up, but we are seeing sort of bigger sort of moves across the board on a lot of these pairs. Euro seems to be just taking it easy. It's like watching an elderly person walk down the road with one of those Zimmer frames. It's slow motion, whereas sterling, Aussie, Kiwi banging around, obviously also dollar CAD. Now we are starting to see oil fall. You know what, if the dollar wasn't falling, as in on the back of what the Fed, Jerome Powell said, the Fed governor, president, wherever he is, chairman, I think we can start to see dollar CAD fall. Like the CAD crosses in particular, probably pressure on the downside on the CAD crosses with that move in oil. Dollar Swiss, dollar yen, not much to see. I wouldn't be getting too excited, but this is where you need to really tune up your focus, because today we have the Bank of England coming out with their spiel on what's going on. Now, there's a bunch of things going on here. And from what I've been reading, right, you've got a number of different factors to look at. The rate decision, the vote count, and what they're doing on the stimulus side of things. So, but with this, just having a look across the board, this is where obviously a tool like Metastock comes into play. You can get a real handle on what the market is looking for with regards sterling. Now, I've just been reading through particularly this sort of report here. Now, it's one of the most line ball decisions, I think, unpredictable meetings in some time. So just having a look through this, what did I say? I saw some really cool stuff, which is going to make it extremely difficult to think you're going to be trading this stuff. Now, where are we? Just down here. Oh, okay. Just check out this guy from HSBC. Thursday's Bank of England meeting. Now, he sees three potential outcomes. A potential 15 basis point rate hike. like, I just can't see that happening. But it's obviously out there and in the spectrum, with or without central bank pushing back on market pricing. Usually, if they want to get an impact, they raise rates by a small amount. Then they come out quickly, like Jerome Powell did, and said, "Look, that's it for the moment. Don't get alarmed. We're not going crazy." Okay. Or if they want to be aggressive, they raise rates by a small amount and say, "Look, there's more coming." Right. That second one there is hawkish. The first one, you get obviously a spike in sterling with the raise of rates, but then the dovish tone afterwards flips it straight back over to where it was. So it's not easy to trade at all. And the last one there, no rate rise at all, right? But what they may do if they don't raise rates is go, we are getting very close. And that hawkish tone should give sterling a bit of a boost to the top side. So for my view, I mean, I think just coming back to sterling, the chart here, with those outcomes, you got to sort of anticipate the outcomes themselves. And I'm just focusing on sterling against the dollar. Well, that is sterling. You look at the sterling crosses, it could be a little bit different. So if they do raise interest rates, right, you're going to see sterling pop to the top side. Now, the other conundrums here, if they talk about further rate hikes coming, it goes aggressively. If they talk about that's it for rate hikes for now, and we're just going to see how things pan out over the next year, well, you see the initial spike and then you see it come straight back down again. Right? If they don't raise rates at all, well, it's probably just going to whip around a bit. I'd say there'd be a slight move lower. Okay. Looks like there's a small part of the market which is factoring in a rate hike. So with these three outcomes, and this being one of the, up the top here, it's sort of saying that one of the most unpredictable rate decisions in years, right? They haven't done anything in years. So of course it's going to be in years, but with the various outcomes, it's a line ball decision. What happens here, you can expect high volatility, right? Straight after this, regardless. Now, the only outcome I can see being very clear is, or there's two really. Let me just get two different colors here. So if they raise rates by 0.15, right, and then talk about further rate hikes coming, you're going to get a double whammy, and sterling should be at least 100 points higher. Right, that's a clear trading opportunity. If they don't raise rates and they talk about we aren't raising rates anytime soon, well, then you're going to get a double whammy to the downside. Right, outside of that, it's going to get a bit convoluted. They could raise rates. They talk about no more rate hikes. It goes back down. You're just going to get really choppy markets. Okay. Same time, if they talk about if there's no rate hike, you're going to get a shoot down. They say, but we're getting close. It shoots back up. Right. So really, to me, the only really trading opportunities is a rate hike plus a hawkish tone, right? That sends it topside, or on the downside, no rate hike, sends it lower, and then you don't want them talking it up, the future prospects up. So no rate hike and a dovish tone would give it a big move to the downside, right? So as you can see, just trying to factor in those three opportunities in execution, it is extremely problematic. Okay, I would only be trading this release if I had, probably one target in mind, whether it's a rate hike, get onto that. As I said, the statement can come out very dovish, even though they raise rates, and that can be an up-down situation. So just be aware there's going to be a huge amount of risk on this because the market doesn't know what to expect. In fact, the three outcomes are a bit convoluted, and they have the extra layer of comments from the central bank as well as the statement there too. So, you know what, like looking at that, it's way too hard, right? As I said, standing back, getting the answers, looking at the market for 5 or 10 minutes may be an answer. And just coming back to the charts on that, still on there, if they do raise rates and they talk about further rate hikes coming, you'll see it spike up. But what you should also see, you get a chance for it to just retrace after that and then look for a move higher, if that's the case. So what I would be doing and anticipating is, if it's a really hawkish rate hike situation, is looking for those retracement levels, okay, and that you're gauging momentum at that point. Like, these things will not just go up 100 points in one straight line. It'll go up 50, come back 20, go up 30, come back 10. There's a process here. Right. And that's what it's safer to get in on that retracement than trying to get in when there's no liquidity, trying to hit the market live You might be thinking, I'll have a pending order here, either side, trying to capture anything. Those positions will be flushed out before the data comes out. Believe me, right? The spreads here, because of the crazy unknown about what's going to happen, what you will actually have is just very wide pricing. Now, for those traders who see their MT4s and they may have pricing, say it's only 10 or 15 point spread, there's no depth in the pricing. So you hit that one or someone hits it, there's nothing between there and say 50 points higher. So don't think just because you've got rates on your screen that there is actually any depth to them or volume, right? That's what happens here. The banks pull all their volume, they leave tiny volume around the market. When it moves, there's no volume to trigger or cover any trades. So in fact, you actually do get gapped all over the place anyway. So don't think it's going to be easy. Now, coming back into this, I think I've got to head off early Friday. So let me just cover a little bit of Friday's non-farm payrolls. To me, the non-farm payrolls is going to be an easier opportunity this month than previous, right? We've got the plan here. I mean, unfortunately, the Canadian numbers come out at the same time. Bad for the CAD traders. But with the US numbers, we've got the Fed has given us clear guidelines. To me, this is a situation where better numbers, it just goes towards potentially giving us an earlier rate hike from the Fed, right? That is like we should see dollar strength. If the numbers are weak, it's just going to go down because it takes the pressure off the Fed. So now that we've got the tapering starting and the dates and what they're going to do, the data actually becomes easier to trade because we know exactly what it's doing. Before, we're looking for employment for them to start tapering, right? And then the rate hikes. But now we've got the tapering in place. This is going closer toward the rate hike situation. Sure, it's at least a year out, but stronger numbers here points towards their plan. And actually, you know what? Stronger numbers blows out Jerome Powell's transitory inflation numbers, right? So strong employment numbers Friday, buy dollars, weak numbers, sell dollars. It's getting more vanilla. And this is probably one of the first non-farm payroll numbers that I've seen where it's probably going to be an easier opportunity than trying to think about what all the ramifications are. And that's because we're working through the Fed's plan. And the actual fact is the fact that he's told us that they think the data will be transitory, especially inflation, makes the CPI numbers huge. And the employment numbers, they're along for the ride as well. All right, so summarizing all of that, the Bank of England today, mate, it's going to be tricky as, right? You're going to be very lucky to stay in your positions. If you are trading, small position size, wide stop loss parameters. Friday, I reckon you could get yourself a little bit excited and rip into the non-farm payrolls because, as I said, if it's a clear-cut strong number or weak number, we've got good trading conditions. All right, guys, that's it from me. Have a good trade day. All the best. Cheerio.